morning, everybody. It's a pleasure to be here. And I would like to thank the Global Risk Institute and the Ivy Business School for the kind invitation to provide some thoughts on the direction of U.S. banking regulation, which, as you've heard already this morning, is in the process of some rather major rethinking and redirection. It's a very great pleasure to be back in Canada, especially on the eve of its sesquicentennial, and also a great pleasure to be here in Toronto, a city I'm always happy to explore. There's always something new and exciting going on in Toronto. Even the Toronto Maple Leafs were exciting this season, but unfortunately they ran afoul of my hometown Washington Capitals, who unfortunately challenged them. So, but that's not the only, we're not here to talk about hockey, we're here to talk about other challenges emanating from Washington. Greg talked about a number of the political challenges. I am not going to touch on the political side. My focus is going to be on the regulatory side. And particularly three key themes that I'll touch upon in my remarks this morning. First, the deregulatory agenda that we've been talking about this morning. My view is that the deregulatory agenda under the Trump administration should render the U.S. financial services regulatory environment net positive for international banks with U.S. operations, including a number of Canadian banks that are active in the U.S. Secondly, I think there still is a risk of regulatory balkanization. I think this is a very serious risk that could, if left unchecked, really complicate foreign bank participation in the U.S. market, and as well U.S. bank participation in foreign markets. National authorities really need to come to compromise on coordinated and aligned standards. Another sub-theme that I'll continue to come back to in my remarks this morning is that the appropriate response to this risk of balkanization is the adoption of a more principles-based regulatory framework, a move away from the rules-based regulatory framework that we've seen that was a response to the financial crisis. There are calls for a principles-based approach, most recently in Treasury Secretary Mnuchin's report, but you can't underestimate the potential for headwinds from those who may still argue for a more prescriptive rules-based approach. However, I think, and I agree with Greg, that there is a consensus emerging in Washington that changes need to be made to the regulatory regime, and that greater reliance on principles rather than hard and fast rules may be the appropriate way to proceed. And then finally, I will touch on some current areas of focus among the U.S. banking regulators. This is certainly not an exhaustive list. We wouldn't have enough time today to go through an exhaustive list of all of their concerns. But some things that I think are top of mind, and particularly some things that have been emphasized by regulators who focus primarily on the international banking community. Financial crimes and conduct issues, despite the over $320 billion in fines assessed so far, I don't think these issues are going away. I spent the last 2.5 years of my life very much involved in some of these conduct and financial crimes issues, and have very frequent dialogue with some of the U.S. regulators, and I do not think that they are ready to abandon these types of concerns. Secondly, there are a lot of concerns, or areas, I wouldn't call them concerns, but areas of focus around systems for data management, aggregation, and integration. And some of these systems issues actually tie into the financial crimes and conduct issues, because sometimes the problem is that the bank does not have the adequate systems to detect and prevent and respond to misconduct that's happening right in front of the management of the bank. There are issues of vendor management, especially as we get into more fintech solutions. banks needing to understand the risks that are posed by their vendors, especially vendors who are responsible for critical operations. And then finally, cybersecurity has been mentioned as an area, and it is certainly an area of regulatory focus, again, getting into, especially as it relates to some of the fintech providers. So these are some issues that should cause banking organizations to take a look at the robustness of their policies and their programs and their frameworks in light of regulatory expectations. And I think regulatory expectations in these areas are not going to be diminished. So let's talk about the new deregulatory agenda under the Trump administration. As I said, I think it's going to be a net positive for international banks with U.S. operations. I'm sure this audience is very familiar with Canadian banks with banking operations in the U.S. Currently, the assets, U.S. assets of these banks are approximately $760 billion, so very, very significant to the U.S. economy. Canadian banks are well represented in the foreign banking organizations in the U.S. We use the acronym FBOs in the U.S. FBOs hold about 20% of total U.S. banking system assets. They provide about a third of U.S. business loans, and they comprise over half of the New York Fed's primary dealers. So the importance of FBOs to the U.S. economy is very well recognized, and actually was highlighted in Treasury Secretary Mnuchin's recommendations that were issued earlier this month, the recommendations for regulatory reform. Canadian banks have expanded recently into the U.S. market. I think the last press release I saw was with respect to private bank. They can take advantage of a much less concentrated market in the U.S. We have roughly 5,800 banks in the U.S. That's down from when I was at the American Bankers Association. There were over 8,000, but of course that was prior to the financial crisis. But even with 5,800, we have a good pool of banking organizations in the U.S. market. We also have a large pool of potential customers, obviously. And despite some credit strains that have been discussed here this morning, the latest quarterly reports that I've seen from the large Canadian banks show improving credit and capital metrics, which really position them very well for growth and expansion. So we've talked about Secretary of the Treasury Mnuchin's recent report under the President's executive order, which required the Treasury to conduct a study of existing laws, regulations, the whole panoply of requirements that are applied to banking organizations in light of the President's core principles. I won't go through the President's core principles. Greg covered that very, very well. But what I will do is talk about some of the overarching themes. A first theme of the Treasury report is that insufficiently tailored rules do not align with the risk and complexity of banks. Again, this gets back to a very rules-based, one-size-fits-all type of approach, which applies thresholds, and a lot of these thresholds are very relevant to international banking organizations that impose quite significant costs and burdens on these banking organizations without a corresponding benefit, or at least a demonstrable link to safety and soundness. The money spent on compliance and meeting the requirements of multiple agencies, especially in the U.S., I'll touch upon that in a moment, takes resources away from meeting customer needs and takes resources away from economic growth. Rules are often added without the consideration of unintended consequences and the cumulative benefit. Certainly have seen that in my time as a regulator. Each rule standing alone looks very rational and meets a good purpose, but when one looks at the cumulative impact of capital rules, liquidity rules, stress testing, recovery and resolution plan requirements, It has a very large cumulative burden, and sometimes the interaction of these rules can have very deleterious impacts on the economy. And apart from the rules themselves, it's one thing you have the rules set forth, everybody can read them, but the implementation and enforcement of those rules can vary considerably from one agency to another. In the U.S., we have the Federal Reserve, that's my old alma mater. We also have the Office of the Comptroller of the Currency. We have the Federal Deposit Insurance Corporation. That's only 3 of the 8 federal financial regulatory agencies in the U.S. The approach to implementation and enforcement at the Fed, the FDIC, and the OCC can be very, very different. Some of it relates to the mandate of the agencies. The Fed has much more of a macroprudential mandate. The Federal Deposit Insurance Corporation, true to its name, has a somewhat narrower mandate for deposit insurance protection. So banks of all sizes suffer from this fragmented regulatory system and this insufficient regulatory tailoring. For the larger banks, the gold plating of the international standards, such as those developed in Basel, creates competitive disadvantage. And for the smaller and mid-sized banks, the problem is often that those international standards trickle down to the smaller sized banks. As I mentioned, the multiple banking agencies have overlapping jurisdiction and do not coordinate sufficiently. I touched upon the myriad of banking agencies in the United States. There are also state banking regulators that can be very, very significant players. For those of you who have New York licenses, you know that the Department of Financial Services in the state of New York is a very active player in the regulatory space. Interestingly, the Treasury Secretary's report calls for a possible role for the Financial Stability Oversight Council in coordinating all of the different regulators in the U.S. I have a bit of skepticism about how effective that would be. I'm afraid that would just add one more agency and one more set of players to the mix rather than really creating any efficiencies, but it's certainly a recommendation worth considering. The other aspect of the Treasury Secretary's report that gives me some pause is the call for greater executive branch oversight of some of the agencies, and particularly the independent agencies. I think that's very dangerous. I think allowing the executive branch, and particularly the president, to have veto power and to be able to remove the heads of independent agencies is a step in the wrong direction. We talked about the cost of compliance. We've talked about the inhibition of economic growth. Again, come back to the point that we need to harmonize rules and standards. We need to harmonize within jurisdictions. The U.S. has a great need to harmonize within the U.S. and also to harmonize internationally. So I agree with some of the prior speakers that regulatory reform is much more likely to emanate from the Treasury recommendations and actions at the agencies than from legislative proposals. There is a lot going on legislatively. There is a lot of bipartisan bickering. We have the Choice Act I agree with prior commenters that it is very unlikely to earn enough support in the Senate to pass. And it's also overshadowed by other legislative initiatives, health care, tax reform, that may overshadow. But I think that there is a good potential for the deregulatory agenda to be advanced through the administrative process and through administrative rulemaking. We've heard some very encouraging statements from Jay Powell recently and from the Federal Reserve, and I think that other agencies will also, I think that's consistent with a theme in Washington of needing to needing to advance and roll back some of the more onerous provisions of the Dodd-Frank Act. And the areas that I think have the potential, the greatest potential to benefit international banks are higher thresholds for the application of enhanced prudential standards. As you know, there are 10 billion and most significantly 50 billion asset thresholds in Dodd-Frank for the application of enhanced prudential standards. Some of the changes would need legislative action if they involve an amendment to Dodd-Frank that will have to go through Congress. But there are some very significant changes that could be made to the intermediate holding company provisions that a lot of your banks are subject to without going through the legislative process. Those can be done at the administrative level because they are not creatures of Dodd-Frank. They're creatures of the Federal Reserve. So I think that there's great scope for recalibrating some of the intermediate holding company regulatory standards, including raising some of the thresholds for the application of the standards, for the application of CCAR stress testing, which can be very burdensome. And also, more importantly than just raising the dollar threshold, is recalibrating the threshold to focus on U.S. assets, not global assets. I think that would alone would make a major change. And allowing for greater flexibility in structuring the U.S. operations in light of the banking organization's global footprint, and allowing for a number of different structures within the intermediate holding company structure itself. I don't think IHCs are going to go away. But I think there's scope for quite a few changes that would make the IHC structure less burdensome for foreign banks that are subject to that. I think there's great scope for aligning some of the IHC recovery and resolution plans to align more with the global plans that are already overseen by crisis management groups and supervisory colleges. We already have mechanisms for this. And so I think there is much more that could be done to recognize that the global plans and the supervisory colleges and the crisis management groups are the right vehicle for dealing with some of these issues. And also, I think there's greater scope for considering intra-group sources of capital and liquidity and parent support. There is a lack of recognition that for a number of banking organizations, certainly Canadian banking organizations, that there is significant parent support and that there is less of a need for an extreme ring fencing at the U.S. level. There should be some relief also. There already has been some relief for the smaller IHCs from some of the stress testing requirements. I think there's room for a lot more progress on stress testing, progress in terms of loosening some of the standards, moving to a 2-year cycle, eliminating some of the scenarios. Right now you have 3 scenarios, potentially 2. So I think stress testing is one area that's really ripe for a major overhaul. The Treasury report recommends relief to the imposition of the restrictions on proprietary trading and the ownership and sponsorship of covered funds under the Volcker rule. And I think those loosening of those restrictions, I think, has a very good chance of gaining some traction in Washington. Certainly, Jay Powell has advocated for some rethink on the Volcker rule. The Volcker rule, compliance with the Volcker rule, I'm sure I don't have to tell a number of you in the audience, compliance with the Volcker rule is very, very difficult. The exceptions under the Volcker rule are very narrowly crafted. There are a number of legal questions that sometimes have to be met or answered in terms of determining whether a particular exception applies or not. And banks are often more likely to draw back from conducting certain activities if they think that there is a chance that they will run afoul of the Volcker rule. And then that really constrains some activity, and particularly hedging activity, that may be very beneficial and may be very, very appropriate. There is some talk about reducing the compliance and documentation requirements under the Volcker rule, which can be very, very onerous. And also for covered funds, allowing a little more flexibility, extending the seeding period to 3 years, I think would be of great benefit, because a 1-year seeding period just is, I have some experience with helping some funds, and the 1-year seeding period, by the time you're up and running and getting some traction, you're running into the 1-year limit. Also, reconsidering some of the treatment of the funds as affiliates subject to the Federal Reserve's 23A. And then for FBOs, there are calls for eliminating some of the limitations on activities for foreign funds, which I think should resonate very well with this audience. And particularly, there are some very draconian rules about the use of U.S. personnel. U.S. personnel literally can't touch the fund. Otherwise, there are some exceptions, but they are very difficult to. You have to maintain a lot of documentation and show that, in fact, they were only engaged in administrative activities. They were not engaged in marketing the fund. They were not engaged in the active management of the fund. So I think that relaxation of the Volcker rule has a lot of positive. Would have a lot of positive impact on international banks. And then more stringent impact analysis and greater agency accountability and transparency in supervision. I think there are a couple areas where this is, I think, warranted and needed across the board, but 2 areas where I think it's particularly important. One is in living wills. I have some experience in helping a foreign bank write the living will for review by the U.S. regulator. And sitting down with my former colleagues at the Federal Reserve and talking to them when the living will comes back and there are comments, there are questions, there are concerns, it doesn't quite meet the needs of the regulator, and sitting down and saying, well, what exactly do you mean by this? What exactly are you looking for? And getting pretty much the answer, we don't exactly know, but we will know it when we see it, and we haven't seen it yet. So I think that there is a call for greater guidance on the living will process. The same thing in terms of the stress testing. I did mention there is some relief on the qualitative aspects of the stress testing. Excuse me, but that is for the smaller institutions. I think for some of the larger institutions, there needs to be greater clarity around the stress testing expectations. Okay. Greg touched on this in his remarks. Others have as well. U.S. banking agency leadership is in flux. There is a lot of change among the leadership of the U.S. banking agencies. I would also emphasize that there's a lot of change at the staff level. The General Counsel of the Federal Reserve has retired, and he is leaving his position shortly. No new General Counsel has yet been named. The General Counsel is very important. He is not she is not responsible for banking supervision, but all of the initiatives that come out of banking supervision and regulation at the Fed also go through the General Counsel and his or her staff. So that's a very important position. There are also a number of my former colleagues have announced retirements, so there are a lot of vacancies in some of the very key positions. The gentleman who was responsible for CCAR has announced that he is leaving the agency. People might not be too sad about that, but it does create some question as to what, if change is going to happen, who is going to take forward those changes? And unfortunately, what I find in dealing with my clients is that the unsettled leadership has led to delay and inertia. It is very difficult. I have clients who have some not groundbreaking, but just pretty everyday types of applications, types of requests for interpretive questions, requests for regulatory relief in some form or another, and the response that we tend to get is, we just can't do anything right now. We're in a state of flux. We don't know who the new head of this function is going to be. We don't know who the new general counsel is going to be. So that does create some difficulty. The other thing is, I would say, I'm very positive on the prospects for regulatory reform at the administrative level, but please do not underestimate the time it takes to get a proposal through the notice and comment period, through the consideration of all of the comments that come in, and through the final rulemaking process. I am a veteran of that. I'm a veteran of that at the Federal Reserve for 15 years. I'm a veteran of that on the international scene with the international standard setters. It takes a long time, and particularly when you have interagency rulemaking, which almost everything is at this point. Anything that is of major concern to this audience would be well, I shouldn't say that. There are some things that would just be Federal Reserve, but a lot of very significant rulemakings do have that interagency component, and that can be a very, very lengthy process. Okay, so we talked about international regulatory balkanization. We've talked about the international standard setters are encountering roadblocks to convergence. The comment was made, maybe Canada will go its own way. There are disagreements over the Basel capital floors. There are disagreements over the fundamental review of the trading book, which talk about something with long legs. I mean, that was an initiative I started working on in the mid-90s. We're looking at the trading book. It wasn't the fundamental review of the trading book back then, but it was the same issues. So a lot of these have had very, very long lives. Implementation of the net stable funding ratio, which is the longer-term liquidity ratio, is very controversial, and there are calls for the U.S. not to implement these agreed standards. And other countries are also considering the impact on their domestic markets, properly so. There are, concerns in response to macroeconomic concerns and just concerns that the consensus is falling apart. And this isn't just a banking issue. Same issues are faced in the insurance industry, where the international regulators have been working on creating an international capital standard for the the largest internationally active insurance groups. And so this is an issue that is crossing sectors. And unfortunately, with the insurance standard setters, you also have the problem that a lot of the legwork, a lot of the original work was done on the banking side, and there seems to be an exportation of banking-like approaches to the insurance sector, which I don't have to tell this audience has a very different business model, a very different balance sheet. You also have very different accounting standards from jurisdiction to jurisdiction, and those are complicating matters quite a bit in the IAIS. And that's why I come back to the idea that a move towards a principles-based approach that would reflect different regulatory regimes, different accounting regimes, different business models could really go a long way towards resolving some of these rather intractable differences among jurisdictions. And those a principles-based approach also has to be reflected in the implementation and enforcement, in the supervisory colleges, in realizing that different approaches are appropriate for different types of organizations. And then, of course, we come back to the cumulative impact issue, which also permeates all of these considerations. So what if we don't do this? What if we don't adopt a principles-based approach? What if we end up with divergent national rules-based approaches to supervision and regulation? These are just a few of what I see as the unintended consequences of that type of movement. One is increased operational and compliance costs, barriers to market entry, barriers to globalization, disincentives to innovation, and constrained capital and liquidity flows across global markets, across borders. And I think what's really important is uncertainty, and that ties back to my earlier comments about the regulatory agencies being in flux, the uncertainty that creates. I have clients who are trying to engage in long-term strategic planning for the next 5 years. They can't do that because they don't know how they're ultimately going to structure their operations. And that just is an uncertainty that impacts all of the business decisions, all of the different areas of that business organization. And on the international side, it really provides incentives for firms to reduce their global footprint, which is counterproductive. We want the global footprint to increase, and there's an incentive for firms to draw back in light of differing standards and in light of that uncertainty. So in the last 15 minutes or so, I'm going to talk about the U.S. banking regulatory agenda and just highlight some areas that are what I see as continuing areas of concern among the U.S. banking regulators, areas that have been emphasized and that I think will continue to be emphasized, notwithstanding any move towards a deregulatory environment. First of all, financial crimes and conduct issues. It's top of mind for me because of how I've spent the last couple of years, but I think it's every week, sometimes more than once a week. One picks up the Financial Times, one picks up the Wall Street Journal. There's the announcement of another fine, there's the announcement of another investigation, another enforcement action. So I think that these conduct issues and financial crimes issues are going to continue. They have focused on the foreign exchange market. They focused on manipulation of the interbank offered rates, the AML, the counter-terrorist financing rules. These are the OFAC rules are all going to remain top of mind for the regulators. And the other area where I don't think enforcement actions are going to slow is anything that relates to consumer harm. There was a recent publication of an action involving the Fair Credit Reporting Act, where punitive damages were assessed, and that was because the company did not properly distinguish between its customers who clearly were on the OFAC list and those who had names who were similar to those on the OFAC list. Unfortunately, they were, in some cases, denied banking services, denied credit. And even if the regulators were to say all of a sudden they were going to pull back, which I don't think they're going to, the impact of private litigation cannot be underestimated. When you see these announcements of consent orders and enforcement actions, quite often the private litigants are right on the heels. And so that ties into some of the comments I want to make a little bit later on, but I think there's a real role, I've seen it in the work that I've done recently, a real role for fintech and for some of the new technology to partner with banks. I think banks often see fintech and see these disruptive technologies as disruptive. And they are. In some ways, they are disrupting the banking model. But they can also partner with the banking model to help a bank's ability to engage in detecting and preventing financial crimes and harms. There's some great predictive technologies out there. There's some great use of big data and machine learning. Okay. I think we've covered most of these. The one thing I would say on the AML side is banks have to balance the customer demand. Everybody wants faster and greater access to their accounts, but there's a natural tension there between the bank's need to make sure that those accounts are not being used as a vehicle to facilitate financial crime. And again, I think that's where fintech and some of these new technological advances can really help banks with that balance and with meeting customer needs and the customer interest in having it. You know, right now, I want to send money. I don't want to wait, and also making sure that is done in a manner that is safe and sound and consistent with not allowing the bank's platforms to be used for inappropriate reasons. On the financial crimes and conduct issues, there are a number of cross-border differences among the regulators in different jurisdictions. Even the acronyms are different. My Canadian husband corrected my slide because I had different acronyms that mean different things in Canada versus the U.S. So that's just one minor thing, but there are different definitions, different requirements. There are different responsible agencies. And then, of course, those of you who are acting as correspondent banks have that additional layer of complexity through the correspondent relationship where there's another layer in between you and the ultimate customer. I think the other area of concern I touched on was data management, integration and aggregation systems, also vendor management, which I'll touch on in a minute. I noted different systems for payment processing and clearing across the border. Again, have some personal experience with that since we have both U.S. and Canadian bank accounts in my household. Talking to the CEO of Payments Canada, very exciting innovations in Canada in terms of enhancements to the payment system, the adoption of ISO 20022. The U.S. Needs to catch up on these international standards and payment systems as well. Actually, we need to catch up on chip and PIN. It's really embarrassing. We have the chip sometimes. We don't have the PIN. Sometimes we don't even have the chip. And it's amazing that you go all around the world, and the U.S. is behind the curve on that. So I'm getting the 5-minute warning here, so I'm just going to talk about vendor management quickly. As you know, banks rely on fintech providers, as they rely on third-party systems, particularly for critical operations. There is an important need for greater rigor in testing and validation and documentation and oversight of vendors. I can't overestimate the importance of documentation for the regulators. That is really, really important. Don't just do the validation and testing, but make sure you have a record of that validation and testing. Anything that touches, in terms of vendor management, anything that touches the consumer, again, very heightened interest in anything that touches the consumer. Anything that protects the bank against financial crimes or misconduct. I believe the regulators are really going to start to raise the bar very significantly on their expectations for systems to detect and prevent financial crimes and misconduct, and to detect and prevent any harm to consumers. So I won't go through cybersecurity very much in the interests of time. Also recognizing we have other speakers who are much more adept at speaking on cybersecurity than am I. Canadian banks are very well sensitized to cyber risk as well. I talked about the high penetration of the electronic banking channels here, much ahead of many of your peers, including your neighbors down south. The U.S. regulators have prioritized cyber risk, but the approach has been a bit fragmented and not well coordinated, and that's an area where they really do need to improve their coordination going forward, both within the U.S. and internationally. Just a couple of thoughts on, divergent standards are not just costly and inefficient, but they're also dangerous if it impedes information sharing among the regulators. And I think there's a need for the continued public-private partnership, which has already been well established, both domestically and internationally. So I won't go through the executive order on cybersecurity. It's on the website. You can read that, and just talks about the international cooperation and the coordination among the U.S. agencies on cybersecurity. Very welcome. And then, again, I mentioned this a little bit earlier, just a few thoughts on risk mitigation and the very beneficial uses of fintech and big data technologies. So with that, I will leave I think we have a few minutes for questions, and thank you very much for your kind attention.
Okay, so one of the questions that a number of people would like is to get your opinion on which of the Canadian banks is best positioned for success in the United States.
Oh, I'm not going to pick favorites. I'm not going to pick favorites. I'll say all of the Canadian banks.
All of the Canadian banks?
How's that for a diplomatic response?
Maybe another way of phrasing it is, what is it about, what characteristics of the Canadian banks, either their practices or their culture, do you think is going to provide them a competitive advantage in the United States?
I think it's the uptake of the electronic banking channels. I think it's your embrace of new technologies and innovation. I think it's the fact that you are ahead of the curve on a lot of these issues. And certainly, as I said, we have the chip, but we don't have the pin. You're way ahead in terms of some of those innovations. And
you mentioned that foreign banking organizations are probably going to do well in the coming years, benefit from the sort of the deregulation. Do you see Canadian banks doing any better, or is there a reason why you might think that Canadian banks might do better than other foreign banking organizations, or is this sort of general for all non-U.S. banks?
I think it's a general observation, but I do think the Canadian banks are particularly well positioned because the Canadian and the U.S. banking regulatory regimes are very similar. There's a good working relationship between OSFI and the U.S. banking regulators. Certainly good coordination among the central banks. And I think there is more of a principles-based approach in Canada that I think can migrate to the U.S. And I think that, but I think that the mindset and the approach and the concerns, I think, are very similar on both sides of the border. And then there's just that natural proximity that facilitates cross-border expansion.
Yeah. Michael?
Yep. Okay, Jen.
Okay. As Canadians, we're seeing a couple of American business groups be quite aggressive in their trade strategies. We've got the lumber dispute, we've got a dairy dispute, we've got actions against Bombardier in the transportation area. You've been saying some very potential positive things about how regulatory reform could help foreign banks or Canadian banks in the U.S. Is it going to be different? I mean, we've got an administration that's really egging on America first as an attitude. So when you look at all of that dynamic and what's happening in some of those other sectors, and you're talking about as the Americans approach regulatory reform in financial services that could benefit foreign banks, are we going to be immune from that particular psychology? And if so, it would be interesting why. But I guess the first part is, do you think we're going to be immune from that kind of America First psychology that seems to be driving trade strategies in some of the other sectors?
Well, I'll say first, I am not a trade expert or an NAFTA expert, so I'll preface it with that. The America First ideology was very prevalent during the election campaign. I've seen a pullback from that. Obviously, Trump said he was going to abrogate NAFTA. He did not. I'm seeing more of a conciliatory mood. It's certainly something that Canadian firms will have to keep their eye on, but I'm seeing a more positive mood than the mood we heard during the campaign. So I think that it's guardedly optimistic. Is the way I would put it.